Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're getting a few consequential pieces of economic data over the next couple of weeks, although we do expect trading to be relatively light because of the coming holiday. But jumping right in with the economy, this week we have information on consumer confidence. This is the big one, which is expected to show a 100 on the index, which is a decline from the prior reading of 102. And that suggests that, consumers may be pulling back, or at least that was what the expectation is. And we're not so sure we're going to see that. And even if we do, we're not sure what that means until we see what's happening. Where are pockets of demand starting to wane a bit, or where are the demand factors remaining relatively strong? Will give us a lot more idea what's going on than just the headline number. But this does move the market, and because we're in that holiday period over the next couple of weeks, markets might make some exaggerated moves. They tend to do that because traders and investors are taking vacation time at this time of the year, and markets being thinner, there's not as much volume in there. Prices can move further than they would under normal conditions of liquidity. So we'll be watching that number and potentially some turbulence around it. Then we get information about the real estate market. We get GDP. That's another really big one, showing a 1.4% growth. At least that's what's expected in the third and final revision of Q1 GDP. And that is up 0.1%, meaning that analysts seem to think that it was underestimated on the prior reading. What that potentially informs Fed policy, which we are going to talk about a little bit later because we got some massive information about that in the past couple of weeks as well. We'll get inventories information, which shows, what's going on between retailers and wholesalers in their inventories, gives us an idea of how they see future events playing out in the economy, what they see sales results being like. So it's important data. We're going to get durable goods orders. Again, that's expected to show a pretty sharp decline, 0.2% month over month, when the last reading was a 0.6% climb. And that's notable because consumers tend to pull back in times where they're expecting a market to not be as good or the economy to not be as good. So we're watching that one as well. But again, that's a volatile number. Doesn't mean much in isolation. It only means something in the context of a mosaic of information that's going on to give us a picture what's happening in the economy and markets. And moving in later on, we've got personal spending. We get the PCE core deflator, the Fed's main gauge of inflation, which is expected to show a 0.1% month over month climb, and that's down a bit from the 0.2% prior reading. And we're going to get analysts are looking for a 2.6% on the year over year, which is down 0.2% from the prior reading. Is this number really coming down? Who knows? Evidence might suggest not as rapidly as the Fed would like. And, we're going to, again, talk about that when we talk about the Fed. But even this 2.6 number here is still too high for what they're telling us they target. Sure, they've come out with some language that suggests they're okay with 2.5% inflation for a while. But this 2.6 is still a little bit hotter than that and ties their hands effectively in terms of cutting rates. We'll get sentiment information. We'll get information on the manufacturing sector and employment again. More durable goods orders, and then the big one, the change in non-farm payrolls coming up on the 5th, which is expected to show, 190,000 jobs created in the month of June versus 272,000 the month prior. This number has consistently been coming in hotter than analysts expected, and the labor market is a real sticking point for the Fed in terms of whether they're in a position to cut rates or not. We will be watching this number, but our expectation is it will again come in hotter than expected. And what that means is they're creating more jobs in the economy than were expected, and the economy is continuing to show this resiliency, particularly with respect to the labor market. And then we'll get the unemployment rate, which is expected to be at 4%, and this is relatively notable. It's high. It's the same as it was the last time, at least in terms of the expectation, and we do not mind seeing a 4% unemployment rate. In fact, in the economics classes, 5% is what was considered for a long time to be the sustainable rate of unemployment in the economy for GDP growth to continue. So, without overheating the economy. So this is actually a positive development, even though it may not look positive on the surface. Going into the market, well, the S&P 500 just continues its march higher. This is stepping up. However, there is a bit of a disconnect that's starting to develop in the market. And what we're going to do is we're going to look at this, and this is a bull market. There's no question. However, when we look at the S&P equal weighted index, which takes out the effect of the Magnificent Seven and the other market leading stocks, you see a vastly different picture. You see a market that's really been range bound since March and kind of just trading in the middle of its range. What that says is stocks are mainly just treading water right now in general in terms of the market, the broader market, and then the market leadership is what's propping this up and continuing to go up in the cap weighted S&P 500. So we are paying attention to that disconnect. It suggests that conditionings might actually be softening a bit, which would allow the Fed a little bit more latitude. Going into volatility, that's climbing again, not to levels that are of concern, but volatility expectations are climbing according to the VIX Volatility Index. So we're watching that a little bit carefully. And, like I said before, in the thinner market conditions around a holiday, you tend to see more exaggerated moves, which might account for that expectation of a little bit more volatility. So what's going on with the Fed? They came out, they kept rates the same. They telegraphed potentially a rate cut by the end of the year, which we are not so sure is the base case. When you look at this dot plot, which is here, this gray shows what the reading was at the prior meeting, which was in March, where they issued this dot plot. And then yellow dots represent what happened at this meeting. And the dot plot is basically a survey of where each member of the Reserve Board goes in and gives their estimate of where they think rates will be in a certain time period. In other words, in 2024. And uniformly, these went up pretty dramatically, the baseline being about 4 5/8 back there to being more like 5 1/8, or 4 7/8 ish in terms of rates. They're saying we expect rates to remain higher for longer, and that is essentially where they get that idea of we're expecting one cut. But when you look here out to the longer term in 2025, again, the expectations are higher. When we go out to look at 2026, these expectations down here for lower rates are now moved and shifted above the main median line here, and it's looking like their expectations are rates are going to remain higher for longer. And it even happened here over the longer term. Some of these dots down here fell off and came in up on the higher end of the spectrum. What this suggests is that Federal Reserve officials believe that rates are going to be higher for longer, and it might be somewhat at odds with what market expectations are, which seem to be pricing in cuts. So, are the Fed governors going to cut rates? We don't know, but it doesn't look like they're going to do so aggressively if and when they do. Looking at the Treasury curve, a lot's been mentioned by the media in the past couple of weeks about how rates have been coming down and compressing. Sure, in the past month, rates on the 10-year are down 20 basis points. Rates on the 30-year are down 15. That is not really great when you think about it from the context of where they began the year, which, the 10-year is still up nearly 40 basis points, and so is the 30. So, looking at it from the perspective of year to date, this is still up pretty dramatically in terms of rates, and the Fed has not been hiking. So what that tells us is inflation expectations remain high among bond market participants. Looking into the corporate sector, the same story holds. The green line is the current yield curve, and that's down a bit. Rates have come down at 10 years, down 17 basis points, 5 years down 19, which seems like a great deal until you look at it in terms of the 5-year rate is up almost 45 basis points and the 10-year rate is up 42. So, what's really happening with rates? They're remaining elevated. And this is a good thing for a number of reasons, the chief of which is fixed income investors get to take in higher incomes on the portion of their portfolios that either are hedging against volatility or are being used to live on in retirement, and then or fund other cash flows for that matter. Then it also has the effect of higher interest rates. A higher weighted average cost of capital for corporations is going to make the market more efficient. When money is free, and essentially interest rates are the price of money, when money is free, a lot of projects that maybe shouldn't get funded, and you have inefficiency in the market and excess. When rates are a little bit higher, corporations are a bit more careful with the purse strings in what they're going to invest in, and you tend to see a more efficient marketplace. And we're going to close with the S&P 500 like we always do. Remaining cognizant of the fact that the broader market seems to be shifted into, the sell-in may go away and just kind of trickling along even right now. And market leadership continues to climb because it's active stocks. But do we really have a keen interest in this? Not really. We're not investing for this smaller period. We're investing for the longer haul over decades, and we're not going to make changes to good long-term investment plans because of short-term market activity. So market makes new highs, stick to the plan. Market starts going down, stick to the plan. Market makes new lows, stick to the plan, because the plan is there to take volatility out of your financial goal setting and execution of that. So with that said, hope you found this video useful, and feel free to reach out and call us if you've got questions about your portfolio or about the markets or about the economy. Thanks. Have a great day.